Hi there, preparing for C213 OA exam can feel overwhelming, but it doesn't have to be. Stick with us and we're going to help you with it. We built a free question bank for the C213 OA exam. Preparing for an OA is no joke, so our guides and practice questions are completely free. In this video, we will cover questions from financial reporting, statement analysis, cash flows, cost accounting, CVP analysis. So, let's get started.
1. A startup founder discovers that different accounting firms are giving conflicting advice about how to report certain transactions. Which organization is primarily responsible for setting the official accounting standards that publicly traded companies in the United States must follow when preparing their financial statements? A. Securities and Exchange Commission. B. Internal Revenue Service. C. Financial Accounting Standards Board. D. American Institute of CPAs. Can you guess the answer? Correct answer, C. Financial Accounting Standards Board. Explanation. Option C is correct because the Financial Accounting Standards Board is the private body that establishes accounting standards in the United States, supported by the business community, financial analysts, and practicing accountants. Option A is incorrect because the Securities and Exchange Commission regulates US stock exchanges and ensures fair information for investors, but it does not write the accounting standards that companies follow. Option B is incorrect because the Internal Revenue Service establishes tax rules to define when income should be taxed, and has no role in setting the financial accounting rules for company statements. Option D is incorrect because the American Institute of CPAs is the professional organization for certified public accountants and does not have the authority to establish the official accounting standards used nationwide. All right, let's get right into this one. Who actually writes the accounting rules in the United States? A startup founder is getting conflicting advice from different accounting firms, and they need to know which body sets the official standards. The answer is the Financial Accounting Standards Board, or FASB. The FASB is a private organization, not a government agency, supported by the business community, financial analysts, and practicing accountants. It writes the standards that publicly traded companies follow when preparing financial statements. Now, people often confuse the FASB with the SEC. The SEC regulates stock exchanges and makes sure investors get fair information, but it does not write accounting standards. The IRS, that's strictly tax rules. It has zero role in financial accounting standards. And the AICPA is the professional organization for CPAs, but it doesn't set the rules either. Here's a WGU C213 OA exam tip for you. When a question asks who sets US accounting standards, the answer is FASB. SEC enforces, IRS taxes, AICPA certifies. But FASB writes the rules. Quick recall hook. FASB = Foundation of Accounting Standards for Business. 2. A bank is reviewing a mid-sized company's financial data before deciding whether to approve a loan request. The bank focuses on evaluating the company's ability to generate sufficient future cash flows to meet repayment obligations. Which type of financial statement user best describes the bank in this scenario? A. Lender. B. Investor. C. Competitor. D. Government agency. What do you think is the answer? Correct answer, A. Lender. Explanation. Option A is correct because lenders use financial accounting information specifically to evaluate the cash flows a business can be expected to generate in the future in order to repay loans they provide. Option B is incorrect because investors use financial information to assess the attractiveness of companies as investment opportunities, focusing on potential returns rather than specifically evaluating loan repayment cash flows. Option C is incorrect because competitors analyze financial accounting information primarily to reveal strategic opportunities within their own industry, not to evaluate whether a specific company can repay borrowed funds. Option D is incorrect because government agencies use financial statement data to support political and regulatory positions regarding companies, not to make lending decisions about a company's future cash flows. This question is about knowing your financial statement users. A bank is reviewing a company before deciding on a loan. The bank cares about one thing above all else. Can this company generate enough cash to pay us back? That makes the bank a lender. Lenders use financial accounting information to evaluate the cash flows a business can generate in the future to repay loans. Investors look at similar data, but their goal is different. They want to know if the company is a good investment. They're chasing returns, not loan repayments. Competitors study financial statements to find strategic openings in their industry. Government agencies use the data to support political and regulatory positions. Each user type has a distinct reason for reading the same financial statements. Here's a WGU C213 OA exam tip for you. If the question mentions evaluating cash flow for loan repayment, that's a lender. Investors want returns, competitors want strategy, government wants regulation. Quick recall hook. Lender = loan repayment focus. 3. After a wave of corporate accounting scandals, Congress passed legislation creating a new oversight body with the power to inspect audit firms, set auditing standards, and impose sanctions on firms engaging in questionable audit practices. Which organization was established through this legislation to perform these specific oversight functions? A. Financial Accounting Standards Board. B. Securities and Exchange Commission. C. International Accounting Standards Board. D. Public Company Accounting Oversight Board. Can you guess the answer? Correct answer, D. Public Company Accounting Oversight Board. Explanation: option D is correct, because the Public Company Accounting Oversight Board was created by the Sarbanes-Oxley Act to inspect audit firms, establish auditing standards, and impose sanctions for questionable audit practices. Option A is incorrect because the Financial Accounting Standards Board is a private body that sets accounting standards for financial reporting, not a government-created entity that inspects or sanctions audit firms directly. Option B is incorrect because the Securities and Exchange Commission existed long before the scandals and regulates stock exchanges, though it did not perform the specific audit oversight functions described in this question. Option C is incorrect because the International Accounting Standards Board was formed to develop worldwide accounting standards and operates globally, not as a US congressional response to domestic corporate accounting scandals. Here's a question about the fallout from the big corporate accounting scandals. After companies like Enron and WorldCom blew up, Congress passed the Sarbanes-Oxley Act. That law created the Public Company Accounting Oversight Board, the PCAOB. The PCAOB has real teeth. It inspects audit firms, sets auditing standards, and can impose sanctions on firms that do shady work. It can even bar a firm from auditing public companies. Now, the FASB existed before these scandals and focuses on writing accounting standards, not policing auditors. The SEC also existed long before Sarbanes-Oxley and handles stock exchange regulation. The IASB works on global accounting standards, not domestic audit oversight. The key distinction here is that the PCAOB was specifically born from scandal-era legislation to oversee auditors. Here's a WGU C213 OA exam tip for you. If you see Sarbanes-Oxley, think PCAOB. If the question says inspect audit firms or impose sanctions on auditors, that's the PCAOB every time. Quick recall hook. PCAOB = police for CPA oversight of books. 4. A professor explains that 3 major factors have combined to create significant change in accounting. One factor is the rapid advance in information technology. A second is increased scrutiny following large corporate scandals. Which of the following best describes the third factor driving this transformation? A. Rising costs of audit services. B. International integration of worldwide business. C. Decline in accounting enrollments. D. growth of cryptocurrency markets. Can you guess the answer? Correct answer. B. International integration of worldwide business. Explanation. Option B is correct because the international integration of worldwide business is one of three factors, alongside information technology advances and increased scrutiny from scandals, driving significant accounting changes today. Option A is incorrect because while audit costs may be rising, the source material does not identify the cost of audit services as one of the three major factors creating significant change in accounting. Option C is incorrect because a decline in accounting program enrollments is not identified in the source material as one of the three factors combining to drive significant change in the profession. Option D is incorrect because the growth of cryptocurrency markets is not listed as one of the three major factors driving transformation in accounting, despite its potential effects on financial reporting practices. This one is testing whether you know the three big forces changing accounting right now. The question gives you two of them: rapid advances in information technology and increased scrutiny after corporate scandals. The third factor is the international integration of worldwide business. Think about it. Investors buying stocks across borders are frustrated because every country has different accounting rules. You can't compare a Japanese company's financials with an American company's if they're using different frameworks. That demand for harmonization is pushing massive change in the profession. Rising audit costs, declining enrollments, and cryptocurrency are interesting topics, but they're not the three factors identified in the source material. Here's a WGU C213 OA exam tip for you. Memorize the trio: technology, scandals, and globalization. If you see a question listing two of them and asking for the third, just recall which one is missing. Quick recall hook: TSG. Technology, scandals, globalization. The three drivers of accounting change. 5. A company's marketing director requests detailed internal cost reports to determine which product lines are most profitable. These reports are not shared with outside parties and are customized for the company's specific decision-making needs. Which branch of accounting is designed to produce this type of information for internal users? A. Managerial accounting. B. Financial accounting. C. Tax accounting. D. Forensic accounting. What do you think is the answer? Correct answer: A. Managerial accounting. Explanation. Option A is correct because managerial accounting is the name given to accounting systems designed specifically for internal users, providing customized information for planning, control, and internal decision-making purposes. Option B is incorrect because financial accounting focuses on producing the three primary financial statements specifically for external users such as investors and creditors, not customized internal decision-making reports for managers. Option C is incorrect because tax accounting deals with rules established by the Internal Revenue Service to define when income should be taxed, not with producing internal management decision-making reports. Option D is incorrect because forensic accounting involves investigating financial fraud and irregularities within organizations, not producing the routine internal cost reports and profitability analyses that managers need for everyday decisions. A marketing director wants customized internal cost reports to figure out which product lines make the most money. These reports stay inside the company. No outside party sees them. That's managerial accounting. The distinction between managerial and financial accounting is straightforward. Managerial accounting is for internal users. Financial accounting is for external users. Financial accounting produces the big three statements: balance sheet, income statement, cash flows, all following standardized rules so outsiders like investors and creditors can compare companies. Managerial accounting has no such standardization. It's a competitive tool. Each company builds its own internal system to generate the specific data it needs. Tax accounting deals with IRS rules, and forensic accounting investigates fraud. Neither one produces the routine internal reports a marketing director needs. Here's a WGU C213 OA exam tip for you. Internal users and customized reports always point to managerial accounting. External users and standardized statements point to financial accounting. Quick recall hook. Managerial = management inside. Financial = financiers outside. 6. A new accountant is told that one financial statement provides a snapshot of a company's financial position at a single point in time, listing what the company owns, what it owes, and the residual interest belonging to owners. Which financial statement is being described in this particular scenario? A. Income statement. B. Statement of cash flows. C. Statement of retained earnings. D. Balance sheet. Can you guess the answer? Correct answer, D. Balance sheet. Explanation. Option D is correct because the balance sheet reports a company's assets, liabilities, and owner's equity at a specified point in time, providing a snapshot of the company's overall financial position. Option A is incorrect because the income statement describes a company's financial performance over a period of time by reporting revenues and expenses, not a snapshot of position at one specific date. Option B is incorrect because the statement of cash flows details how a company obtained and spent cash during a certain period of time, categorizing transactions into operating, investing, and financing activities. Option C is incorrect because the statement of retained earnings shows changes in retained earnings over a period, tracking profits kept in the business minus dividends, not the full financial position overview. A new accountant is told about a statement that gives a snapshot, a single point in time, showing what a company owns, what it owes, and the leftover belonging to owners. That's the balance sheet. The balance sheet lists assets, liabilities, and owner's equity. It's governed by the accounting equation. Assets = liabilities plus owner's equity. The income statement covers a period of time and shows revenues minus expenses. The statement of cash flows also covers a period and tracks where cash came from and went. The statement of retained earnings follows profits kept in the business over time. Only the balance sheet gives you that single date snapshot of financial position. The words point in time versus period of time matter a lot on exam questions. Here's a WGU C213 OA exam tip for you. Snapshot and point in time are dead giveaways for the balance sheet. Anything describing a period of time or during the year points to the income statement or cash flow statement. Quick recall hook. Balance sheet = birthday photo. Income statement = home video. 7. A corporation has been profitable for several years, but has never distributed profits to its shareholders. Instead, all profits have been reinvested back into growing the business. On the balance sheet, which specific equity account would reflect the cumulative amount of profits kept inside the company? A. Paid in capital. B. Retained earnings. C. Treasury stock. D. Accumulated other comprehensive income. Can you guess the answer? Correct answer, B. Retained earnings. Explanation. Option B is correct because retained earnings is the cumulative number of corporate profits that have been retained within the business rather than being paid out to stockholders as dividends over time. Option A is incorrect because paid in capital represents the amount that stockholders have directly invested in the corporation through purchasing stock, not the profits that have been reinvested in the business. Option C is incorrect because treasury stock represents the amount a corporation has spent to buy back its own shares from stockholders, which is actually reported as a subtraction from equity on statements. Option D is incorrect because accumulated other comprehensive income reflects increases and decreases in equity due to movement of market prices or exchange rates, not retained operating profits from business activities. A corporation has been profitable for years but never paid dividends. All profits stayed in the business. Where does that show up on the balance sheet? Retained earnings. Retained earnings is the running total of profits a corporation has kept rather than distributing to stockholders. Paid-in capital is different. That's the money stockholders directly invested when they bought stock. Treasury stock is actually a subtraction from equity. It represents shares the company bought back from its own stockholders. Accumulated other comprehensive income tracks changes from things like currency exchange rate movements and market price swings, not operating profits. The key word in this question is cumulative profits retained. That maps directly to retained earnings. Here's a WGU C213 OA exam tip for you. Profits kept inside the company always means retained earnings. Money stockholders put in means paid in capital. Stock the company bought back means treasury stock. Quick recall hook. Retained earnings =sign profits. Retained never distributed. 8. A financial analyst notices that a technology company reports significant value in patents and trademarks on its balance sheet. The analyst knows the company has spent millions developing its own brand reputation internally. Why would the internally developed brand not appear as an intangible asset on this balance sheet? A. Brand value is always immaterial. B. The FASB prohibits all brand reporting. C. Companies report only purchased intangibles. D. Brands are classified as current assets. What do you think is the answer? Correct answer. C. Companies report only purchased intangibles. Explanation. Option C is correct because in reporting intangible assets, companies report the intangibles that they have purchased from other companies, but not the intangibles that they have developed themselves internally. Option A is incorrect because the value of an internally developed brand could be very material and significant. And materiality is not the reason these assets are excluded from the balance sheet under reporting rules. Option B is incorrect because the FASB does not prohibit all brand reporting on the balance sheet. Companies can and do report intangible brand assets that they have acquired through purchasing them from others. Option D is incorrect because brands and other intangible assets are classified as long-term assets rather than current assets. But classification type is not the reason internally developed brands are excluded. A tech company reports patents and trademarks on its balance sheet, but its own internally built brand, worth millions, is nowhere to be found. Why? Because companies only report intangible assets they purchased from other companies. Self-developed intangibles don't make it onto the balance sheet. If this company had bought another company's brand in an acquisition, that would appear as an intangible asset. But the brand they grew themselves? Invisible on the financial statements. This isn't about materiality. The brand could be worth a fortune. And the FASB doesn't ban all brand reporting. It just draws the line between purchased and self-developed. Brands are long-term assets, not current assets, so that's a red herring too. Here's a WGU C213 OA exam tip for you. If a question asks why an internally developed asset is missing from the balance sheet, the answer is always about the purchased versus developed distinction. Quick recall hook. Purchased intangibles =sign on the sheet. Built it yourself =sign off the sheet. 9. A manager is reviewing a company's balance sheet and notices that total assets equal $500,000 while total liabilities equal $300,000. Using the fundamental accounting equation that governs every balance sheet, what must be the amount of owner's equity for this company? A. $200,000. B. $800,000. C. $500,000. D. $300,000. Can you guess the answer? Correct answer, A, $200,000. Explanation. Option A is correct because the accounting equation states that assets equal liabilities plus owner's equity. So owner's equity is the difference between $500,000 in assets and $300,000 in liabilities. Option B is incorrect because $800,000 would result from adding assets and liabilities together, which is not how the accounting equation works when determining the owner's equity balance. Option C is incorrect because $500,000 is the total amount of assets, not the owner's equity amount, which must be calculated by subtracting liabilities from total assets under the equation. Option D is incorrect because $300,000 represents the total amount of liabilities the company owes, not the residual interest belonging to the owners after those obligations are subtracted from assets. A manager sees total assets of $500,000 and total liabilities of $300,000. What's the owner's equity? $200,000. That's the accounting equation at work. Assets equal sign liabilities plus owner's equity. Rearrange it. Owner's equity equals sign assets minus liabilities. 500,000 minus 300,000 equals 200,000. Simple arithmetic, but the exam will try to trip you up. 800,000 is what you get if you add assets and liabilities together. That's wrong. 500,000 is just the assets number. 300,000 is just the liabilities number. The equation always balances. Every single transaction a company records must keep this equation in balance. Here's a WGU C213 OA exam tip for you. When you see an accounting equation question, write out a =L plus OE and plug in the numbers. The answer that doesn't fit the equation is always wrong. Quick recall hook. O=L plus OE. Assets minus liabilities equals what the owners get to keep. 10. An investor wonders why a company's balance sheet reports the value of its headquarters building at a price far below current market rates. The building was purchased decades ago and has appreciated significantly since. Which accounting concept best explains why the building is still reported at the lower original price? A. Conservatism principle. B. Materiality concept. C. Going concern assumption. D. Historical cost principle. What do you think is the answer? Correct answer, D. Historical cost principle. Explanation. Option D is correct because accountants frequently report assets at their historical cost rather than their current value, which often results in companies' reported accounting values being significantly less than actual market values. Option A is incorrect because conservatism involves recognizing all losses but not recognizing gains until they are certain, which is a different concept from the practice of initially recording assets at purchase price. Option B is incorrect because the materiality concept addresses whether a dollar amount is large enough to make a difference to anyone, not the method used for valuing long-term assets on the balance sheet. Option C is incorrect because the going concern assumption means assets do not need to be reported at liquidation value since the company is expected to continue operating, not that original cost must be used. An investor is puzzled. A company's building is worth far more today than what the balance sheet shows. The building was bought decades ago and has gone up in value. The answer is the historical cost principle. Accountants frequently report assets at what they originally cost, the purchase price, rather than the current market value. That's why reported values often lag behind reality. Conservatism is a different concept. It's about recognizing all losses but holding off on gains until they're certain. Materiality asks whether a dollar amount is big enough to matter. The going concern assumption says you don't have to report assets at fire sale liquidation values because you assume the company keeps operating. None of those explain the gap between purchase price and current market value. Here's a WGU C213 OA exam tip for you. If a question asks why an asset is reported below market value and it was purchased long ago, think historical cost. The keyword is original purchase price. Quick recall hook. Historical cost equals what you paid, not what it's worth today. 11. A financial analyst wants to forecast next year's earnings for a company that recently sold off an entire business division. The analyst needs to identify the income measure that best represents the company's ongoing sustainable profitability by excluding the effects of that one-time disposal. Which income measure is most appropriate? A. Gross profit. B. Income from continuing operations. C. Net income. D. Comprehensive income. What do you think is the answer? Correct answer, B. Income from continuing operations. Explanation. Option B is correct because income from continuing operations is the best baseline from which to forecast a company's income for the following year, as it excludes discontinued operations and extraordinary items. Option A is incorrect because gross profit only measures the difference between selling price and cost of products sold, without subtracting operating expenses, interest, or taxes needed for a complete profitability picture. Option C is incorrect because net income includes the results of discontinued operations and extraordinary items, which makes it less useful than continuing operations income for forecasting sustainable future performance. Option D is incorrect because comprehensive income adds adjustments for changes in exchange rates, interest rates, or financial instrument values to net income, which are not useful for predicting core operating profitability. An analyst wants to predict next year's earnings, but the company just sold off an entire division. Which income measure strips out that one-time event and shows the company's ongoing repeatable profitability? Income from continuing operations. This measure takes operating income, subtracts interest and taxes, and adds or subtracts miscellaneous items. But it specifically excludes discontinued operations and extraordinary items. That makes it the best starting point for forecasting future performance. Gross profit only looks at revenue minus cost of goods sold, too narrow. Net income includes everything, including that division sale, so it's muddied by one-time events. Comprehensive income adds even more noise with exchange rate and market value adjustments. Here's a WGU C213 OA exam tip for you. Forecast, sustainable, or ongoing profitability. In a question, all point to income from continuing operations. Net income is the all-inclusive number. Quick recall hook. Continuing operations equals the repeatable earnings baseline. 12. A software company signs a contract to deliver a custom application over 6 months. The client pays the full amount upfront on day 1. The accountant must decide when to record this payment as revenue on the income statement. Which condition must be met before revenue can be recognised? A. The required work must be performed. B. Cash must be deposited first. C. Both parties must sign the contract. D. The fiscal year must end first. Do you know the answer? Correct answer. A. The required work must be performed. Explanation. Option A is correct because revenue should be recognised when the work has been done and the collection of cash is reasonably assured, not simply when cash is received before the work begins. Option B is incorrect because merely depositing cash in the bank does not satisfy revenue recognition requirements. The company must also have performed the work that the payment was intended to compensate. Option C is incorrect because signing a contract establishes a legal agreement between parties, but does not by itself mean that the company has delivered the value needed to recognise revenue in its statements. Option D is incorrect because revenue recognition depends on when work is completed and cash collection is reasonably assured, not on the arbitrary timing of when a fiscal year happens to end. A software company gets the full payment up front for a 6-month project. Can they record all that cash as revenue on day 1? No. Revenue recognition requires that the work has been performed and cash collection is reasonably assured. The company hasn't built the software yet. Receiving cash isn't enough. You have to deliver the value first. Depositing cash in the bank doesn't satisfy the requirement. The work still needs to be done. Signing a contract creates a legal agreement, but it doesn't mean the company has delivered anything. And waiting for the fiscal year to end has nothing to do with it either. Revenue recognition is tied to work completion and collectability, not calendar dates. Here's a WGU C213 OA exam tip for you. Revenue recognition has two conditions: work done and collection assured. If a question describes upfront payments with work not yet performed, revenue cannot be recognized yet. Quick recall hook: work done plus cash collectible equal sign. Recognize revenue, cash alone is not enough. 13. A manufacturing company purchases raw materials in January, uses them to produce goods in February, and finally sells those finished goods to customers in March. According to the matching concept, in which month should the cost of those raw materials be recognized as an expense on the income statement? A. January when purchased. B. February when used in production. C. March when goods are sold. D. Spread equally across all 3 months. Do you know the answer? Correct answer: C. March when goods are sold. Explanation: Option C is correct because the matching concept states that an expense should be recognized in the same period in which the revenue it helped generate is recognized, meaning March when the sale occurs. Option A is incorrect because recognizing the expense at the time of purchase would violate the matching concept, since the revenue from selling those materials as finished goods has not yet been earned. Option B is incorrect because while the materials were physically used in production during February, the matching concept ties expense recognition to the period when the related revenue is earned from customers. Option D is incorrect because spreading the cost equally across 3 months has no basis in the matching concept, which specifically links expense recognition to the period when corresponding revenue is generated. Raw materials purchased in January, used in February, goods sold in March. When does the cost hit the income statement? March, when the sale happens. That's the matching concept. The idea is simple: match the expense to the period when the revenue it helped generate is recognized. The customer pays in March, the revenue goes on the income statement in March, and the cost of those raw materials becomes an expense in March too. Recording the expense in January when you bought the materials would be premature. No revenue yet. Recording it in February when you used them in production? Closer, but still no sale. Spreading it evenly across 3 months has no basis in accounting theory. The matching concept creates a direct link between expenses and the revenues they produce. Here's a WGU C213 OA exam tip for you. The matching concept always pairs expenses with the period of the related revenue. If the question gives you a production timeline, expense recognition happens at the sale date, not the purchase or production date. Quick recall. Hook: match expense to revenue period. Sold in March equals sign expense in March. 14. A retail company earns money primarily through selling clothing to consumers. During the year, the company also earns a small profit from selling an old delivery truck that was no longer needed for operations. How should the profit from selling the delivery truck be classified on the income statement? A. Revenue from sales. B. Operating income. C. Cost of goods sold. D. Gain from peripheral activity. Do you know the answer? Correct answer: D. Gain from peripheral activity. Explanation: Option D is correct because gains arise from activities that are peripheral to a company's main operations, and selling an old delivery truck is not part of the company's normal clothing retail business. Option A is incorrect because revenue from sales specifically refers to income generated through the company's primary business operations of selling clothing to consumers, not from disposing of old equipment assets. Option B is incorrect because operating income measures the performance of fundamental business operations conducted by the company, and selling surplus equipment falls outside the scope of those core operations. Option C is incorrect because cost of goods sold refers to the direct cost of products a company sells to customers, not the proceeds or profit from disposing of an old delivery truck. A clothing retailer earns a small profit selling an old delivery truck. How does that show up on the income statement? As a gain from peripheral activity. Gains and losses arise from activities that sit outside a company's main operations. Selling clothes to customers? That's revenue from the core business. Selling an old truck? Peripheral. It's not what this company does for a living. Revenue from sales is reserved for the primary business. Operating income measures performance of fundamental operations. And truck disposal doesn't qualify. Cost of goods sold refers to the direct cost of products sold to customers, which has nothing to do with equipment disposal. The distinction between revenue and gains matters because gains signal one-time events, while revenue reflects ongoing business activity. Here's a WGU C213 OA exam tip for you. If the question describes profit from selling an asset that isn't part of the company's normal product line, that's a gain, not revenue. Quick recall hook: core business =, revenue, side activity =, and gain. 15. A potential investor is comparing two companies of very different sizes and wants to understand how much profit each company generates for each individual share of stock outstanding. Which specific metric, reported on the income statement, provides this per-share profitability information that the investor needs? A. Gross profit margin. B. Earnings per share. C. Return on equity. D. Operating income ratio. Do you know the answer? Correct answer: B. Earnings per share. Explanation: Option B is correct because earnings per share is the amount of net income divided by the number of shares of stock outstanding, showing how much profit is associated with each individual share. Option A is incorrect because gross profit margin shows the percentage of revenue remaining after subtracting cost of goods sold, but it does not express profitability on a per-share basis for individual investors. Option C is incorrect because return on equity measures the pennies in profit for each dollar invested by stockholders as a group, rather than the profit amount attributable to each individual share outstanding. Option D is incorrect because the operating income ratio relates operating income to revenue as a percentage measure of overall operational efficiency, without providing any specific information about per-share profitability for investors. An investor is comparing two companies of very different sizes. They want to know how much profit each company earns per share of stock. That's earnings per share, or EPS. EPS is calculated by dividing net income by the number of shares of stock outstanding. It puts companies on a level playing field regardless of size. A company earning 10 million with 1 million shares has an EPS of $10. A company earning 100 million with 50 million shares has an EPS of $2. Without EPS, comparing profitability across different size companies is almost impossible. Gross profit margin measures the percentage of revenue left after cost of goods sold. Wow. It doesn't touch per-share numbers. Return on equity measures profit relative to stockholder investment as a group. Operating income ratio relates operating income to revenue. None of those give the per-share figure. Here's a WGU C213 OA exam tip for you. Anytime you see per share or per individual share in a question, the answer is EPS, quick recall. Hook: EPS =, earnings per share =, net income divided by shares outstanding. 16. A company's treasurer is preparing the annual statement of cash flows and must classify each transaction into the correct category. The company paid salaries to employees, collected payments from customers, and paid suppliers for inventory throughout the year. Into which cash flow category do all three of these transactions fall? A. Operating activities. B. investing activities. C. Financing activities. D. Non-cash transactions. What do you think is the answer? Correct answer, A. Operating activities. Explanation: option A is correct because operating activities are those activities that comprise the day-to-day operations of a business, including paying salaries, collecting customer payments, and paying suppliers for inventory. Option B is incorrect because investing activities involve the purchase and sale of long-term assets such as land and equipment, not the routine daily business operations like paying employees and collecting from customers. Option C is incorrect because financing activities involve receiving cash from or repaying cash to owners and creditors, such as issuing stock or repaying loans, not the daily operational transactions described in the question. Option D is incorrect because non-cash transactions involve exchanges that do not use cash at all, such as acquiring long-term assets by issuing stock, while all three transactions described specifically involve cash payments. The Treasurer is classifying transactions for the cash flow statement: paying employee salaries, collecting from customers, paying suppliers. Where do these go? Operating activities. Operating activities are the day-to-day transactions that make the business run. If it enters into the calculation of net income, it's an operating activity for cash flow purposes. Investing activities are about buying and selling long-term assets like land and equipment, not daily operations. Financing activities involve cash between the company and its owners or creditors, issuing stock, taking loans, paying dividends. Non-cash transactions involve no cash at all, like acquiring equipment by issuing stock. All three transactions in this question clearly involve cash changing hands as part of normal business operations. Here's a WGU C213 OA exam tip for you. Salaries, customer collections, and supplier payments are textbook operating activities. If it's a day-to-day business transaction involving cash, it's operating. Quick recall hook: daily business cash = operating. Long-term assets = investing. Owners and creditors = financing. 17. An analyst reviewing a company's cash flow statement notices that operating cash flow is strongly positive, investing cash flow is negative, and financing cash flow is also negative. Based on these patterns, which description most likely characterizes the stage and financial behavior of this particular company? A. A startup seeking external funding. B. A company facing bankruptcy. C. A mature company repaying obligations. D. A company with no capital expenditures. Can you guess the answer? Correct answer: C. A mature company repaying obligations. Explanation: option C is correct because a mature company typically generates positive operating cash flow, spends cash on maintaining long-term assets creating negative investing flow, and repays debt or returns cash to shareholders. Option A is incorrect because a startup seeking external funding would typically show positive financing cash flow from receiving investments or loans, not negative financing cash flow, indicating repayment of those obligations. Option B is incorrect because a company facing bankruptcy would likely show negative operating cash flow rather than the strongly positive operating cash flow pattern described in this particular scenario being analysed. Option D is incorrect because the company's negative investing cash flow directly indicates that it is spending cash on capital expenditures or other long-term asset purchases, contradicting the idea of no capital expenditures. The cash flow statement shows positive operating, negative investing, and negative financing. What kind of company is this? A mature company repaying obligations. Here's the logic. Positive operating cash flow means the business generates cash from its daily activities. That's healthy. Negative investing means it's spending cash on long-term assets like equipment. That's normal maintenance and growth. Negative financing means cash is flowing out to creditors and shareholders. The company is repaying debt or buying back stock. A startup would have positive financing cash flow because it needs outside money flowing in. A bankrupt company would struggle to generate positive operating cash flow. And negative investing directly contradicts the idea of zero capital expenditures. The combination of strong operations funding, both asset purchases and debt repayment, is the hallmark of a mature, established business. Here's a WGU C213 OA exam tip for you. Positive operating plus negative financing typically signals a mature company that's self-funding and paying down debt. Positive financing signals a young company still borrowing. Quick recall hook. Mature =, makes cash, buys assets, pays back debt. 18. A rapidly growing company reports strong positive net income on its income statement. However, the company's cash balance has actually decreased during the same period. Which characteristic of fast-growing companies best explains why positive net income can occur alongside declining cash balances in this situation? A. Growing companies always commit fraud. B. Net income includes only cash transactions. C. Revenue recognition rules prevent cash collection. D. Rapid growth operations consume cash faster. Do you know the answer? Correct answer. D. Rapid growth operations consume cash faster. Explanation. Option D is correct because the operations of rapidly growing companies can consume cash even when reported net income is positive, as expansion requires heavy spending on inventory, receivables, and other working capital needs. Option A is incorrect because positive net income alongside declining cash is a normal characteristic of rapidly growing companies and does not indicate fraud. It reflects the natural cash demands of business expansion activities. Option B is incorrect because net income is based on accrual accounting, which includes non-cash items like depreciation and revenue earned but not yet collected, not solely on actual cash transactions received during the period. Option C is incorrect because revenue recognition rules do not prevent cash collection. They determine when revenue appears on the income statement, and a company can recognize revenue while still waiting to collect cash. Strong net income but a shrinking cash balance. Sounds contradictory, right? It's actually common for rapidly growing companies. When a business expands fast, it burns through cash, buying more inventory, extending more credit to customers, hiring staff, leasing space. Accrual accounting records revenue when earned and expenses when incurred, regardless of when cash moves. So net income can look great on paper while the bank account drains. This isn't fraud, it's the normal cash demand of growth. Net income is not a cash-only measure. It includes non-cash items like depreciation. Revenue recognition rules don't prevent cash collection, they just determine when revenue appears on the income statement. The cash flow statement exists precisely because net income alone can be misleading about a company's actual cash position. Here's a WGU C213 OA exam tip for you. Positive net income but cash is declining almost always points to rapid growth consuming cash. The cash flow statement is the reality check on accrual-based income. Quick recall hook, growing fast =. Cash drains fast, even if profits look good. 19. A company's CFO must decide how to present operating activities on the cash flow statement. One method lists individual cash receipts and payments directly, while another starts with net income and makes adjustments. Which method starts with net income and highlights differences between income and cash? A. Direct method. B. Indirect method. C. Accrual method. D. Modified method. Can you guess the answer? Correct answer, B. Indirect method. Explanation. Option B is correct because the indirect method starts with net income and makes adjustments to highlight the reasons for the difference between net income and cash from operations, making it widely used. Option A is incorrect because the direct method lists individual cash receipts and cash payments directly, presenting operating cash flows in an easy-to-understand format rather than starting with net income and adjusting. Option C is incorrect because the accrual method is an accounting basis used to prepare the income statement, not a method for presenting the operating activities section of the statement of cash flows. Option D is incorrect because there is no standard cash flow presentation format called the modified method. The two recognized methods for reporting operating cash flows are the direct and indirect methods only. Two ways to present operating cash flows, direct and indirect. The direct method lists actual cash receipts and payments, cash collected from customers, cash paid to suppliers, cash paid for wages. Easy to read, intuitive. The indirect method starts with net income and makes adjustments to convert accrual-based income into cash. It adds back non-cash expenses like depreciation and adjusts for changes in working capital accounts. The indirect method is harder to grasp at first, but it's valuable because it shows exactly why net income differs from cash from operations. The accrual method is an accounting basis, not a cash flow presentation format. And there's no such thing as a modified method in standard practice. Here's a WGU C213 OA exam tip for you. Starts with net income is the key phrase for the indirect method. The direct method lists individual cash receipts and payments. Quick recall hook. Indirect equal sign starts with income, then adjusts. Direct equal sign lists cash directly. 20. A potential lender wants to evaluate whether a company will be able to repay a proposed 5-year loan. The lender plans to review projected financial statements to assess future repayment ability. Which projected statement would best show if the company can generate enough cash for loan payments? A. Projected statement of cash flows. B. Projected income statement. C. Projected balance sheet. D. Projected retained earnings statement. What do you think is the answer? Correct answer, A. Projected statement of cash flows. Explanation. Option A is correct because projected cash flow statements allow potential lenders to evaluate the likelihood that a loan will be repaid by showing expected future cash generation from operating, investing, and financing activities. Option B is incorrect because a projected income statement shows expected revenues and expenses using accrual accounting, which does not directly reveal whether the company will have sufficient cash available to repay loans. Option C is incorrect because a projected balance sheet shows expected future financial position at a point in time, but does not detail the timing and sources of cash used to repay loans. Option D is incorrect because a projected retained earnings statement only tracks expected changes in accumulated profits kept in the business, providing no information about actual cash flows available for debt repayment. A lender wants to know if a company can repay a 5-year loan. Which projected statement shows future cash generation? The projected statement of cash flows. This statement breaks down expected cash from operating, investing, and financing activities. A lender can see whether the company generates enough operating cash to cover loan payments, whether investing plans will drain cash reserves, and how financing activities change over time. A projected income statement uses accrual accounting, so it shows revenue and expenses but not actual cash availability. A projected balance sheet shows financial position at a point in time but doesn't detail cash movement timing. A projected retained earnings statement just tracks cumulative profits, useless for assessing cash repayment capacity. Here's a WGU C213 OA exam tip for you. Lenders evaluating loan repayment need to see cash, not accrual income. Projected cash flow statements are the go-to tool. Quick recall hook. Loan repayment =, cash question. Cash question =, cash flow statement. 21. A credit manager needs to quickly assess whether a company has enough short-term resources to pay off its upcoming obligations within the next 12 months. The manager wants a single ratio that compares current resources against current obligations. Which financial ratio would best serve this specific assessment purpose? A. Debt ratio. B. Return on equity. C. Current ratio. D. Price-earnings ratio. Do you know the answer? Correct answer, C. Current ratio. Explanation. Option C is correct because the current ratio provides an indication of a company's ability to pay its short-term debts by comparing current assets against current liabilities due within the next 12 months. Option A is incorrect because the debt ratio shows the percentage of total company funding that is borrowed, measuring overall leverage rather than specifically indicating the ability to meet short-term obligations coming due. Option B is incorrect because return on equity measures the pennies in profit for each dollar invested by stockholders, which is a profitability measure that does not address short-term debt payment capacity directly. Option D is incorrect because the price-earnings ratio shows how many dollars an investor must pay for each dollar of current earnings, which is a market valuation measure unrelated to short-term liquidity assessment. Let's talk about a ratio that credit managers love. A credit manager needs to know, can this company pay its bills over the next 12 months? The answer comes from the current ratio. The current ratio compares current assets to current liabilities. Current assets are things expected to be converted to cash within a year. Cash itself, accounts receivable, inventory. Current liabilities are obligations due within a year. If current assets significantly exceed current liabilities, the company can probably cover its short-term debts. The debt ratio measures something different. It shows the percentage of total funding that's borrowed, which is about overall leverage, not short-term liquidity. Return on equity measures profitability per dollar invested by stockholders. The price-earnings ratio tells investors how many dollars they pay for each dollar of earnings. None of those answer the question. Can you pay your upcoming bills? Here's a WGU C213 OA exam tip for you. Short-term obligations or ability to pay upcoming debts. In a question always signals the current ratio. Debt ratio is about total leverage. Return on equity is profitability. PE is market valuation. Quick recall hook. Current ratio equals sign. Can you pay current bills? 22. A consultant uses a framework that breaks return on equity into 3 component parts to diagnose exactly where a company's performance problems originate. The 3 components measure profitability, efficiency, and leverage separately. Which combination correctly identifies the 3 ratios used in this analytical framework? A. Debt ratio, current ratio, gross margin. B. Asset turnover, debt ratio, earnings per share. C. Price-earnings ratio, current ratio, return on sales. D. Return on sales, asset turnover, assets to equity ratio. Can you guess the answer? Correct answer, D. Return on sales, asset turnover, assets to equity ratio. Explanation. Option D is correct because the DuPont framework decomposes return on equity into return on sales measuring profitability, asset turnover measuring efficiency, and the assets to equity ratio measuring financial leverage used. Option A is incorrect because while the debt ratio relates to leverage, the current ratio measures liquidity rather than efficiency, and gross margin alone does not capture the full profitability component used in DuPont analysis. Option B is incorrect because earnings per share is a per-share profitability metric not used in the DuPont framework, and the debt ratio is not the specific leverage measure that this particular analytical framework employs. Option C is incorrect because the price-earnings ratio is a market valuation metric, and the current ratio measures liquidity, neither of which are components of the DuPont framework's decomposition of return on equity. This question is about the DuPont framework, a powerful tool that cracks open return on equity into 3 separate pieces. The 3 components are return on sales, asset turnover, and the assets to equity ratio. Return on sales measures profitability, how many pennies of profit you earn on each dollar of sales. Asset turnover measures efficiency, how many dollars of sales each dollar of assets generates. The assets to equity ratio measures leverage, how many dollars of assets a company acquires using each dollar of stockholder investment. Multiply all 3 together, and you get return on equity. The other answer options mix in ratios that don't belong. The debt ratio is a leverage measure, but not the one DuPont uses. The current ratio is liquidity. Gross margin is a partial profitability measure. Earnings per share and PE ratio are market-facing metrics. None of them fit. Here's a WGU C213 OA exam tip for you. DuPont always has 3 parts: profitability, efficiency, leverage. The specific ratios are return on sales, asset turnover, and assets to equity. If an answer mixes in current ratio, debt ratio, or EPS, it's wrong. Quick recall hook: DuPont equal sign, ROS times at times AT, profitability times efficiency times leverage. 23. An analyst wants to compare the expense structures of 2 companies that are vastly different in total size. To make a meaningful comparison, the analyst converts all income statement numbers into percentages of sales. What is this type of converted financial statement called? And what does it reveal about expenses? A. Common size statement revealing expense pennies. B. Trend analysis showing growth rates. C. Vertical analysis showing dollar changes. D. Ratio analysis showing profitability margins. What do you think is the answer? Correct answer: A. Common size statement revealing expense pennies. Explanation: Option A is correct because common size financial statements are prepared by dividing all numbers by sales, and a common size income statement reveals the number of pennies of each expense per dollar of sales. Option B is incorrect because trend analysis focuses on tracking how specific financial figures change over multiple time periods, rather than converting current numbers into percentages of sales for cross-company comparison. Option C is incorrect because vertical analysis typically refers to expressing items as percentages within a statement, but the answer incorrectly describes it as showing absolute dollar changes rather than percentage relationships. Option D is incorrect because ratio analysis involves computing specific mathematical relationships between pairs of financial numbers, which is a different analytical approach from converting an entire income statement into percentages. 2 companies, one huge, one small. How do you compare their expenses side by side? You use a common size financial statement. You take every line on the income statement and divide it by sales. Now everything is expressed as a percentage. A common size income statement tells you exactly how many pennies of each expense type it takes to generate $1 of sales. That's the beauty of it. Size doesn't matter anymore. Trend analysis tracks changes over multiple periods, which is different. Vertical analysis is a related term, but the wrong answer here describes it as showing dollar changes, which is inaccurate. Ratio analysis computes specific mathematical relationships between 2 numbers rather than converting an entire statement. Here's a WGU C213 OA exam tip for you: dividing all numbers by sales or percentages of sales in a question means common size statements. The phrase pennies per dollar of sales is the classic description. Quick recall hook: common size equal sign everything as a percentage of sales, makes any company comparable. 24. A junior analyst presents a financial ratio analysis and confidently recommends investing in a company based solely on its strong historical ratios. A senior analyst warns that relying exclusively on financial statement analysis for investment decisions has important limitations. Which limitation is most relevant to this situation? A. Financial statements contain too much information. B. Past data distracts from current information. C. All companies use identical accounting methods. D. Financial ratios eliminate the need for judgment. Do you know the answer? Correct answer. B. Past data distracts from current information. Explanation. Option B is correct because focusing on historical financial statement data may cause analysts to overlook important current information, and analysis usually points out areas needing more investigation rather than giving definitive answers. Option A is incorrect because the limitation is actually the opposite. Financial statements do not contain all relevant information needed for decision-making, which means important factors may be missing from the analysis entirely. Option C is incorrect because companies actually use different classification methods, operate in different industry mixes, and apply varying accounting methods, which makes direct comparison between companies potentially misleading and unreliable. Option D is incorrect because financial ratios do not eliminate the need for judgment. In fact, financial statement analysis usually does not provide definitive answers, but only points out areas requiring further investigation. A junior analyst builds a case entirely on historical ratios and recommends buying. The senior analyst pumps the brakes. Why? Because staring at past data can make you miss what's happening right now. Financial statement analysis is backward-looking. It examines what already happened. A company could have fantastic historical ratios, but face a new competitor, lose a key patent, or see its market shrink. If you're glued to the rearview mirror, you'll miss the truck ahead. The other options misstate the actual limitations. Financial statements actually don't contain all relevant information, the opposite of too much. Companies don't use identical methods. They use different classifications and accounting methods, which makes comparison tricky, and ratios absolutely do not eliminate the need for judgment. They just point to areas worth digging into. Here's a WGU C213 OA exam tip for you. When a question warns about the dangers of relying only on financial statement analysis, the answer usually involves backward-looking data missing current realities. Financial analysis points you to questions, not answers. Quick recall hook. Historical data equals sign rearview mirror. Don't forget to look through the windshield. 25. A discount retailer operates with extremely thin profit margins on each sale, but manages to generate an acceptable return on assets. It achieves this by selling enormous volumes of merchandise quickly relative to its asset base. Which concept explains how low margin can still produce satisfactory returns? A. Operating leverage effect. B. Earnings management technique. C. High turnover compensating for low margin. D. Conservative accounting practice. Do you know the answer? Correct answer. C. High turnover compensating for low margin. Explanation. Option C is correct because companies with a low margin can still earn an acceptable return on assets if they have high turnover, meaning they generate many sales dollars per dollar of assets. Option A is incorrect because operating leverage relates to the proportion of fixed costs versus variable costs in a company's cost structure, not to the relationship between profit margin and asset utilization efficiency. Option B is incorrect because earnings management involves intentional manipulation of reported financial results through timing transactions or changing accounting methods, not a legitimate ongoing business strategy of high-volume selling. Option D is incorrect because conservative accounting is the practice of recognizing all losses, but not recognizing gains until they are certain, which is an accounting principle unrelated to the margin versus turnover business strategy. A discount retailer has razor-thin margins. Every sale barely makes a profit. Yet somehow the company earns a solid return on assets. How? High turnover. Turnover is how efficiently a company uses its assets to generate sales. If you only earn 2 cents per dollar of sales, but you cycle through your assets 10 times a year, you're still making 20 cents per dollar of assets. That's the margin turnover trade-off. Think Walmart versus a luxury boutique. Walmart sells massive volume on thin margins. The boutique sells fewer items at fat margins. Both can reach the same return on assets through different paths. Operating leverage is about fixed versus variable costs. Different topic. Earnings management is intentional manipulation of reported results. Conservative accounting is about recognizing losses early and gains late. None of those explain how low margin plus high volume equals acceptable returns. Here's a WGU C213 OA exam tip for you. Thin margins plus high volume always points to high turnover compensating for low margin. If the question describes a discount retailer or high volume business model, that's your answer. Quick recall hook. Low margin plus high turnover. Equal sign acceptable return. Think Walmart. 26. A company discovers that one employee has been both writing checks and reconciling bank statements, which allowed that employee to conceal unauthorized payments for months. Which specific internal control procedure was missing that would have most likely prevented this fraud from going undetected? A. Physical safeguards over assets. B. Independent checks on performance. C. Proper documents and records. D. Segregation of duties. Can you guess the answer? Correct answer. D. Segregation of duties. Explanation. Option D is correct because segregation of duties requires different employees to handle related activities, so no single person controls all aspects of a transaction, preventing this type of concealment. Option A is incorrect because physical safeguards protect tangible assets through locks, security cameras, and restricted access areas, not through separating the responsibilities of writing checks and reconciling bank accounts. Option B is incorrect because independent checks involve periodic reviews of work by others to verify accuracy, but they detect problems after the fact rather than preventing one person from controlling everything. Option C is incorrect because proper documents and records ensure transactions are captured with appropriate paperwork, but documentation alone cannot prevent fraud when one person controls both recording and verification. One employee writes the checks and reconciles the bank statements. That's a recipe for fraud. And sure enough, unauthorized payments went undetected for months. The missing control? Segregation of duties. This is one of 5 types of internal control procedures. The idea is simple. Split up related tasks so no single person handles an entire transaction from start to finish. If one person writes checks and a different person reconciles, the second person catches discrepancies. Physical safeguards involve locks, cameras, restricted areas. They protect tangible assets but don't address who does what with financial transactions. Independent checks are periodic reviews that detect errors after the fact. Documents and records create a paper trail, but documentation alone can't prevent fraud when one person controls both sides. Here's a WGU C213 OA exam tip for you. If a question describes one person controlling both the recording and verification of the same transaction, the answer is segregation of duties every time. The keyword is same employee handling both. Quick recall hook. One person, 2 jobs, no oversight. Equal sign segregation failure. 27. During a routine review, an accountant discovers that a journal entry was posted to the wrong account due to a typing mistake by a bookkeeper. The bookkeeper had no intention of misrepresenting financial data. Which type of financial statement problem best describes this particular situation? A. An unintentional error. B. A disagreement in judgment. C. An act of fraud. D. An earnings management technique. Do you know the answer? Correct answer. A. An unintentional error. Explanation. Option A is correct because errors are unintentional mistakes that can enter the accounting system at the transaction and journal entry stage, or when entries are posted to accounts without deliberate intent. Option B is incorrect because disagreements in judgment involve differences of opinion about what numbers should be reported in financial statements based on different estimates, not simple typing mistakes by bookkeepers. Option C is incorrect because fraud involves intentional misrepresentations in financial statements made to deceive users, while this situation clearly describes an accidental mistake with no deceptive intent at all. Option D is incorrect because earnings management involves deliberate manipulation of reported financial results through techniques such as timing transactions or changing accounting methods, not simple accidental data entry errors. A bookkeeper types a journal entry into the wrong account. No intent to deceive, no financial motive, just a typo. That's an unintentional error. The study material identifies 3 types of financial statement problems: errors, disagreements in judgment, and fraud. Errors are unintentional mistakes that can happen when transactions are recorded or when entries are posted to accounts. Disagreements in judgment involve 2 professionals looking at the same situation and reaching different conclusions about what the numbers should be, like differing estimates on an asset's useful life. Fraud is intentional. Someone deliberately misrepresents data to deceive. Earnings management is a related but separate concept where executives deliberately time transactions or change methods to influence results. The word unintentional in the question is the giveaway. Here's a WGU C213 OA exam tip for you. Accidental mistakes with no deceptive intent equal errors. Different opinions about estimates equal disagreements in judgment. Deliberate misrepresentation equals fraud. Quick recall hook. Accident equals sign error. Opinion equals sign judgment. Deception equals sign fraud. 28. A CEO instructs the accounting department to delay recording several large expenses until next quarter so that current quarter earnings will meet Wall Street analyst expectations. This deliberate timing of transactions to influence reported results is an example of which commonly discussed accounting practice. A. Conservative accounting treatment. B. Revenue recognition compliance. C. Earnings management technique. D. Standard period end adjustment. Do you know the answer? Correct answer. C. Earnings management technique. Explanation. Option C is correct because careful timing of transactions is a recognized technique of earnings management, often driven by pressure to meet external expectations such as analyst forecasts and Wall Street estimates. Option A is incorrect because conservative accounting involves recognizing losses promptly, but delaying recognition of gains until certain, which is a legitimate principle rather than deliberate manipulation of expense timing. Option B is incorrect because revenue recognition compliance means following rules about when revenue should be recorded, not deliberately delaying expense recognition to inflate current quarterly earnings figures for outsiders. Option D is incorrect because standard period end adjustments are routine entries made to properly record accrued items at period close, not deliberate delays designed to manipulate the reported earnings results. A CEO tells accounting to push expenses to next quarter, so current earnings hit the Wall Street target. That's earnings management, specifically the careful timing of transactions technique. Earnings management happens for several reasons: pressure to meet internal targets, pressure to meet external expectations, income smoothing, or preparing for loans and stock offerings. The techniques range from benign to outright fraudulent. Careful timing of transactions sits on the milder end. Changing methods without disclosure is worse. Fictitious transactions are straight fraud. Conservative accounting is a legitimate principle. Recognize losses early, delay gains until certain. That's the opposite of delaying expenses. Revenue recognition compliance is about following the rules for when to record revenue. Standard period end adjustments are routine housekeeping entries like recording accruals. Here's a WGU C213 OA exam tip for you. Deliberate delay of expense recording to meet earnings targets is earnings management through transaction timing. The keywords are delay, timing, meet expectations. Quick recall hook. Delaying expenses to hit targets =sign earnings management. Always. 29. Following major corporate accounting scandals in the early 2000s, new legislation imposed constraints on company management to restore public trust in financial reporting. Under this legislation, which specific requirement was placed directly on the CEO and CFO regarding their financial statements? A. They must perform the external audit. B. They must set all accounting standards. C. They must approve all journal entries. D. They must personally certify reliability. Can you guess the answer? Correct answer. D. They must personally certify reliability. Explanation. Option D is correct because under the Sarbanes-Oxley Act, the CEO and CFO must personally certify the reliability of financial statements, making them directly accountable for the accuracy of reported information. Option A is incorrect because external audits must be performed by independent certified public accountants from outside the company, not by the CEO or CFO, who are members of the company's own management team. Option B is incorrect because accounting standards in the United States are set by the Financial Accounting Standards Board, not by individual company executives like the CEO or CFO of each publicly traded firm. Option C is incorrect because approving individual journal entries is an operational accounting task handled by accounting staff and controllers, not a requirement placed on the CEO and CFO by Sarbanes-Oxley legislation. After the scandals, Sarbanes-Oxley put new constraints on management. One big requirement: the CEO and CFO must personally certify the reliability of their financial statements. No more hiding behind the accounting department handled it. You sign, you're on the hook. External audits are done by independent CPAs. The CEO and CFO don't perform audits. That would destroy the whole point of independence. Accounting standards are set by the FASB, not by any individual company's executives. And approving journal entries is operational accounting work done by controllers and staff. Sarbanes-Oxley didn't create that requirement. The law also required companies to have a code of ethics and prohibited loans to executives. But the personal certification piece is what the question is asking about. Here's a WGU C213 OA exam tip for you. Sarbanes-Oxley plus CEO and CFO in the same question usually means personal certification of financial statements. They don't audit, they don't set standards, they don't approve entries. They certify reliability. Quick recall hook. SOX =sign CEO and CFO, sign for reliability. 30. A company's board of directors hires an independent accounting firm to examine financial statements and issue an opinion on whether they fairly represent the company's financial status. Which statement most accurately describes what this external audit does and does not provide to statement users? A. Assures fairness but not fraud-free operations. B. Guarantees the company is well managed. C. Certifies the company will be profitable. D. Eliminates all risk of financial misstatement. Do you know the answer? Correct answer. A. Assures fairness but not fraud-free operations. Explanation. Option A is correct because the external audit report assures users that the statements fairly reflect financial status, but it does not guarantee that the company is well run or entirely free of fraud. Option B is incorrect because an external audit examines the fairness of financial statement presentation and makes no claims about how effectively the company is being operated or how sound management decisions are. Option C is incorrect because auditors evaluate whether statements are presented fairly according to accounting standards, not whether the company will generate profits or remain financially viable in coming periods. Option D is incorrect because no audit can eliminate all risk of misstatement. Auditors provide reasonable assurance through sampling and testing, but some level of undetected risk always remains in auditing. The board hires an independent accounting firm to examine the financials. What exactly does that audit deliver? It assures users that the financial statements fairly represent the company's financial status. That's it. It does not guarantee the company is well run. It does not promise the company will be profitable. And it cannot eliminate all risk of misstatement. Auditors sample transactions and gather evidence through interviews, observation, confirmation, and analytical procedures. They provide reasonable assurance, not absolute certainty. There's always some residual risk that something slipped through. The audit is a credibility booster for financial statements. Nothing more, nothing less. Here's a WGU C213 OA exam tip for you. External audits assure fairness of financial statements, but never guarantee good management, profitability, or zero fraud. The phrase reasonable assurance is the key. Audits check the statements, not the company's future. Quick recall hook. Audit equals fair statements, not fraud proof, not management proof. 31. A factory manager notices that the total cost of raw materials increases proportionally every time production volume rises, but the cost per unit of raw materials stays exactly the same regardless of volume. Which type of cost behavior pattern best describes how this raw material cost changes? A. Fixed cost. B. Variable cost. C. Stepped cost. D. Mixed cost. What do you think is the answer? Correct answer, B. Variable cost. Explanation: option B is correct because a variable cost changes in total directly with changes in the level of production, but remains constant per unit, regardless of how many units the company actually produces. Option A is incorrect because a fixed cost remains the same in total, regardless of production volume changes, which is the opposite of what happens with raw material costs that increase as production rises. Option C is incorrect because a stepped cost increases with activity, but in discrete steps rather than smoothly and proportionally, which does not match the proportional increase pattern described for these raw materials. Option D is incorrect because a mixed cost contains both a fixed and a variable component, while the raw material cost described here behaves purely as a variable cost with absolutely no fixed element involved. Raw material costs go up every time production increases, but the cost per unit stays flat. That's a variable cost. The total moves with volume. The per unit amount stays constant. Picture it this way. If one widget needs $2 of steel, 10 widgets need $20, 100 widgets need $200. The total changes, the $2 per widget never does. A fixed cost works the opposite way. The total stays constant regardless of volume, but per unit cost drops as you make more. A stepped cost jumps up at certain thresholds rather than increasing smoothly. A mixed cost has both a fixed floor and a variable component on top. Raw materials described here are purely variable. No fixed element, no steps, no mix. Here's a WGU C213 OA exam tip for you. Total changes with volume per unit stays the same is variable cost. Total stays the same per unit changes is fixed cost. Memorize both directions. Quick recall to hook. Variable equal sign varies in total. Stable per unit. 32. A furniture manufacturer is deciding whether to discontinue its patio furniture line. The plant manager's salary is allocated across all product lines, but this manager would remain employed even if patio production stopped entirely. How should this allocated salary be classified for this decision? A. A direct cost of the patio line. B. A sunk cost of the patio line. C. An indirect cost of the patio line. D. An opportunity cost of the decision. Can you guess the answer? Correct answer, C. An indirect cost of the patio line. Explanation. Option C is correct because an indirect cost is assigned to a product or segment, but not actually caused by it. So if the patio line is dropped, the salary remains unchanged. Option A is incorrect because a direct cost is created by a particular product or segment and would disappear if dropped, which does not apply since the manager stays employed regardless of this decision. Option B is incorrect because a sunk cost is a past cost that cannot be changed by any current decision, while the manager's salary is an ongoing future cost continuing regardless of the patio line. Option D is incorrect because an opportunity cost represents benefits not received because of actions not taken, while the manager's salary is an actual expenditure that is allocated across the company's multiple product lines. Should we drop the patio furniture line? The plant manager's salary is spread across all product lines, but that manager stays employed no matter what. That salary is an indirect cost of the patio line. An indirect cost is assigned to a product or segment, but not actually caused by it. If the patio line disappears, the salary doesn't. A direct cost would disappear with the product. Think of the wood and fabric specifically used for patio furniture. A sunk cost is a past expenditure you can't change now. The manager's salary is ongoing, not past. An opportunity cost is the benefit you miss by not taking an alternative action. It's a foregone benefit, not an actual payroll expense being allocated. Here's a WGU C213 OA exam tip for you. If a cost is allocated to a product but would remain even if that product is dropped, it's an indirect cost. If it would vanish when the product goes away, it's a direct cost. Quick recall. Hook. Indirect equal sign stays if you drop it. Direct equal sign dies if you drop it. 33. A car manufacturer tracks 3 categories of costs incurred inside the factory during production. Direct materials and direct labour are 2 categories. Which cost category captures all remaining factory costs such as supervisor salaries and building depreciation that are neither direct materials nor direct labour? A. Period costs. B. Selling expenses. C. Administrative overhead. D. Manufacturing overhead. Can you guess the answer? Correct answer. D. Manufacturing overhead. Explanation. Option D is correct because manufacturing overhead includes all factory costs not classified as direct materials or direct labour, such as supervisor salaries, building depreciation, and miscellaneous indirect materials used in production. Option A is incorrect because period costs are incurred outside the factory or production facility and are reported as expenses in the period they occur, not as part of production cost tracked inside the factory. Option B is incorrect because selling expenses relate to marketing and distributing products to customers and occur outside the production facility, making them period costs rather than factory-related product costs. Option C is incorrect because administrative overhead refers to general business management costs incurred outside the factory, while the question asks about remaining costs occurring inside the factory during the production process. Inside the factory, 3 types of costs make up a product's cost. Direct materials, the raw stuff like steel or wood. Direct labour, the wages of workers assembling the product. And then there's everything else in the factory: supervisor salaries, building depreciation, utilities, glue, screws. All of those remaining factory costs go into manufacturing overhead. The key word is factory. Period costs happen outside the factory. Selling, general, and administrative expenses. They hit the income statement immediately as expenses. Selling expenses cover marketing and distribution. Administrative overhead is general office management. None of those are inside the factory. Manufacturing overhead captures every factory cost that isn't direct materials or direct labour. Here's a WGU C213 OA exam tip for you. If the question says all remaining factory costs not classified as direct materials or direct labour, the answer is manufacturing overhead. If costs are outside the factory, they're period costs. Quick recall hook. Factory leftovers = manufacturing overhead. Outside factory period costs. 34. A business owner spent $50,000 last year renovating a retail location that is now underperforming. The owner is deciding whether to close it or keep it open. A financial advisor says the renovation expense should not influence this forward-looking decision. Which cost concept explains this? A. Sunk cost. B. Variable cost. C. Opportunity cost. D. Product cost. What do you think is the answer? Correct answer, A. Sunk cost. Explanation. Option A is correct because a sunk cost is a past cost that cannot be changed by any decision made now. So the $50,000 renovation is irrelevant to the forward-looking closure decision. Option B is incorrect because a variable cost changes directly with the level of sales or production activity, while the renovation is a one-time past expenditure that does not vary with the store's current volume. Option C is incorrect because an opportunity cost represents benefits not received because of actions not taken, while the renovation expense is an actual past cash expenditure rather than a foregone alternative benefit. Option D is incorrect because a product cost is incurred as part of the production process inside a factory, while a retail location renovation is not related to manufacturing, but is a past capital improvement. The owner spent $50,000 renovating a store. It's now underperforming. Should that renovation cost influence the decision to close or keep it open? No, that's a sunk cost. A sunk cost is a past cost that cannot be changed by any decision made now. The money is spent. It's gone. Whether you close the store or keep it open, you don't get that $50,000 back. Forward-looking decisions should only consider future costs and benefits. Variable costs change with activity. That's not what this is. Opportunity cost is the benefit you give up by choosing one option over another. Product cost is a manufacturing concept for factory expenses. The renovation is none of those. It's simply money already out the door. Here's a WGU C213 OA exam tip for you. Past expenditures that can't be recovered are sunk costs. If a question says already spent or shouldn't influence a future decision, think sunk cost immediately. Quick recall hook. Spent and gone = sunk. Don't let it sink your decision making. 35. A business owner considers leaving a corporate job paying $80,000 per year to run a startup full-time. When calculating the true economic cost, an advisor says the foregone salary must be included. Which cost concept captures this salary being given up? A. Differential cost. B. Out-of-pocket cost. C. Opportunity cost. D. Fixed cost. Can you guess the answer? Correct answer, C. Opportunity cost. Explanation. Option C is correct because an opportunity cost represents benefits not received because of actions not taken, and the foregone salary is a benefit lost by choosing to leave the corporate employment position. Option A is incorrect because a differential cost is a future cost changeable by current decisions, while the foregone salary is not a cost paid but rather income the owner would sacrifice. Option B is incorrect because an out-of-pocket cost involves the outlay of cash or other assets, while the foregone salary does not require any cash payment from the owner and instead represents lost personal income. Option D is incorrect because a fixed cost does not change based on changes in sales or production levels, while the foregone salary is a personal income sacrifice rather than a business operating cost. You're thinking about quitting your $80,000 job to run a startup. Your advisor says you need to count that foregone salary as part of the cost of launching the business. That's an opportunity cost. An opportunity cost is the benefit you don't receive because of the action you didn't take. If you leave the job, you lose the salary. That salary becomes a cost of running your startup, not because you pay it, but because you gave it up. A differential cost is a future cost you can change with a current decision. Relevant, but not the same concept. An out-of-pocket cost involves actually spending cash or using assets. The foregone salary doesn't require you to write a check to anyone. A fixed cost is a business operating expense that stays constant regardless of volume. The foregone salary isn't a business expense at all. It's personal income sacrificed. Here's a WGU C213 OA exam tip for you. What you give up or foregone benefit always points to opportunity cost. It's the road not taken. If no cash leaves your pocket, it's not out of pocket. Quick recall. Hook. Opportunity cost equals sign what you lose by choosing this path. 36. A company discovers that its traditional costing system, which allocates all overhead based on direct labour hours, is distorting true product costs. Management decides to implement a system that identifies specific overhead activities and assigns costs using multiple cost drivers. Which costing approach is being described? A. Standard costing system. B. Job order costing system. C. Process costing system. D. Activity-based costing system. What do you think is the answer? Correct answer. D. Activity-based costing system. Explanation. Option D is correct because activity-based costing identifies overhead cost activities, analyzes costs by those activities, identifies measurable cost drivers, and assigns overhead using multiple drivers instead of a single measure. Option A is incorrect because a standard costing system uses predetermined cost estimates to measure efficiency and variances, not a system that identifies specific overhead activities and assigns costs through multiple cost drivers. Option B is incorrect because a job order costing system tracks costs to individual jobs or batches, but does not necessarily identify specific overhead activities or use multiple cost drivers for overhead allocation purposes. Option C is incorrect because a process costing system accumulates costs by department for mass-produced identical items, rather than identifying individual overhead activities and assigning them through specific measurable cost drivers. The traditional system dumps all overhead into one bucket and allocates it based on direct labour hours. Problem is, not every product uses the same amount of overhead activities. One product might need tons of machine setups and inspections, while another barely needs any. Using labour hours as the only driver distorts both product costs. Activity-based costing fixes that. ABC identifies specific overhead activities, groups costs into pools, and assigns them using multiple cost drivers matched to what actually causes the overhead. The 5 ABC steps: identify activities, analyze costs by activity, find measurable drivers, assign overhead, then use the data to make decisions. Standard costing uses predetermined estimates for efficiency tracking. Job order costing tracks costs by individual job. Process costing accumulates costs by department for mass production. None of those address the multiple driver overhead allocation problem. Here's a WGU C213 OA exam tip for you. Multiple cost drivers and identifies specific activities are ABC keywords. If the question describes moving away from a single allocation base, the answer is activity-based costing. Quick recall hook. ABC equals sign activities, multiple bases, better costs. 37. An ice cream manufacturer performs machine setups and quality inspections each time a new production run begins, regardless of whether the batch contains 50 gallons or 500 gallons. At which activity level should these setup and inspection costs be classified in an activity-based costing system? A. Batch level. B. Unit level. C. Product line level. D. Facility support level. Do you know the answer? Correct answer, A. Batch level. Explanation. Option A is correct because batch level activities take place to support a batch or a production run regardless of that batch's size, matching the description of setups and inspections that occur once per run. Option B is incorrect because unit-level activities take place each time a single unit is produced, while the setups described here occur once per batch, regardless of how many units that batch contains. Option C is incorrect because product line activities support an entire product line, regardless of the number of batches produced, such as engineering design, not activities triggered by the start of each production run. Option D is incorrect because facility support activities exist to maintain the production facility itself and are not related to any particular batch, such as property taxes, factory insurance, and general facility security. An ice cream company does machine setups and quality inspections every time a new production run starts. Whether the batch is 50 gallons or 500 gallons, those activities happen once per run. That's batch-level activity. ABC classifies overhead activities into 4 levels. Unit-level activities happen with every single unit produced. Think machine depreciation per gallon. Batch-level activities happen once per production run, regardless of batch size. Setups and inspections fit here perfectly. Product line activities support an entire product line, no matter how many batches, like engineering design for a specific flavor. Facility support activities keep the whole plant running, property taxes, insurance, security. The trigger question is, does this cost depend on batch count or unit count? Setups happen per batch. That's the answer. Here's a WGU C213 OA exam tip for you. Each time a production run begins, or regardless of batch size, signals batch level. Each unit produced signals unit level. Entire product line signals product line. Keep the facility running signals facility support. Quick recall hook. Once per run =sign batch level. Every unit =sign unit level. 38. In an activity-based costing system, a numerical measure is needed to reflect how much overhead cost each product consumes. For batch-level activities at an ice cream company, the number of production runs serves this purpose. What is the technical term for this type of numerical measure used? A. Cost pool. B. Cost driver. C. Cost allocation base. D. Cost center. Can you guess the answer? Correct answer, B. Cost driver. Explanation: option B is correct because a cost driver is a numerical measure reflecting the amount of specific overhead cost associated with a particular activity, such as the number of batches for batch-level costs. Option A is incorrect because a cost pool is the total accumulated overhead cost for a particular activity category, not the numerical measure used to distribute that accumulated cost across different manufactured products. Option C is incorrect because while cost allocation base is a related concept in traditional costing, the specific term used within activity-based costing for these numerical activity measures is cost driver instead. Option D is incorrect because a cost center is an organizational unit or department that accumulates costs for reporting purposes, not a numerical measure used to assign specific overhead costs to individual products. In ABC, you need a way to measure how much of each activity a product consumes. For batch-level activities, the number of production runs tells you that. This numerical measure is called a cost driver. A cost driver reflects the amount of a specific overhead cost linked to a particular activity. If you have 10 batches of vanilla and 30 batches of chocolate, chocolate drives 3 times the batch-level overhead. A cost pool is the total accumulated cost for an activity category. That's the money in the bucket, not the measure used to distribute it. A cost allocation base is a traditional costing term. The specific ABC term is cost driver. A cost center is an organizational department that collects costs for reporting. None of those are the numerical activity measure. Here's a WGU C213 OA exam tip for you. The numerical measure that links overhead to products in ABC is always the cost driver. Number of batches, machine hours, number of inspections. These are all cost drivers. The cost pool is the total dollar amount. Quick recall. Hook. Cost driver =sign the counter that drives cost to products. 39. A company implements activity-based costing and discovers that one product line costs far more to produce than the traditional system indicated, requiring many more setups and inspections per unit than other products. What makes this improved ABC information most valuable for company management? A. It reduces total overhead costs. B. It eliminates the need for budgeting. C. It leads to significantly better decisions. D. It simplifies the overall accounting process. Can you guess the answer? Correct answer, C. It leads to significantly better decisions. Explanation. Option C is correct because the increased cost of operating an ABC system pays for itself when the improved data results in significantly better decisions about pricing, product mix, and allocation of resources. Option A is incorrect because implementing activity-based costing does not reduce total overhead costs. It redistributes them more accurately across products, and the ABC system itself actually costs more to operate. Option B is incorrect because activity-based costing provides better cost information for decisions but does not eliminate budgeting, which remains a separate and necessary management planning process for all organizations. Option D is incorrect because activity-based costing systems are typically more complex and costly to operate than simple traditional systems based on a single activity measure, such as direct labor hours used. A company implements ABC and discovers that one product line is way more expensive than traditional costing showed. That product needs far more setups and inspections. So what makes this information valuable? It leads to significantly better decisions. The increased cost of running an ABC system pays for itself when the data produces better choices about pricing, product mix, resource allocation, and whether to keep or drop product lines. ABC does not reduce total overhead. The overhead is the same, ABC just distributes it more accurately. ABC doesn't eliminate budgeting either. Companies still need budgets. And ABC is actually more complex to operate, not simpler. Two traits of a good management accounting measure. It reflects economic reality and it motivates correct behaviour. ABC does both better than a system that smears all overhead, evenly using one driver. Here's a WGU C213 OA exam tip for you. The value of ABC is better decisions, not lower costs or less work. So ABC costs more to run, but the improved accuracy makes the investment worthwhile. Quick recall hook. ABC equals sign accurate costs equals sign better decisions. That's the payoff. 40. In an activity-based costing system, certain costs like property taxes, factory insurance, and general security exist simply because the facility operates. These costs cannot be traced to any specific product, batch, or product line. How are these facility support overhead costs typically treated under ABC? A. Assigned equally to all product lines. B. Added to each unit as direct costs. C. Classified as batch-level overhead costs. D. Treated as unassigned common costs. Can you guess the answer? Correct answer. D. Treated as unassigned common costs. Explanation. Option D is correct because in an ABC system, facility support overhead costs are treated as common costs that are not assigned to any specific product, division, or product line since they benefit everything. Option A is incorrect because assigning facility costs equally to all product lines would be an arbitrary allocation that contradicts the ABC principle of only assigning costs traceable through meaningful cost driver measures. Option B is incorrect because facility support costs like property taxes and insurance are not direct costs of any individual product unit, and adding them directly would distort the product cost information ABC provides. Option C is incorrect because batch-level costs are triggered by each production run, such as machine setups and inspections, while facility costs exist regardless of whether any production batches are currently being run. Property taxes, factory insurance, building security, General administration. These costs exist because the factory exists. They have nothing to do with any specific product, batch, or product line. In ABC, these are facility support costs, and they're treated as common costs that don't get assigned to individual products. This is a deliberate choice. ABC only assigns costs when a meaningful cost driver can link the cost to a specific activity. Facility support costs can't be traced that way. Assigning them equally to all products would be arbitrary, the exact kind of distortion ABC tries to avoid. Adding them to each unit as direct costs is wrong because they're clearly indirect. Calling them batch level is wrong because they don't trigger with each production run. They're just the cost of having a building. Here's a WGU C213 OA exam tip for you. Facility support costs in ABC are unassigned common costs. If a question mentions property taxes, insurance, or security, and asks how ABC handles them, the answer is never assigned to products. Quick recall hook. Facility costs equals sign unassigned. No driver, no assignment. 41. A bakery sells each cake for $30, while variable cost per cake total $18. The bakery also pays $8,000 monthly in fixed costs. What financial measure represents the $12 remaining after subtracting variable costs from the selling price of each individual cake? A. Contribution margin per unit. B. Gross profit per unit. C. Operating income per unit. D. Net income per unit. Do you know the answer? Correct answer, A. Contribution margin per unit. Explanation. Option A is correct because contribution margin equals sales revenue minus variable costs, and the $12 remaining after subtracting $18 in variable costs from the $30 price is this measure. Option B is incorrect because gross profit subtracts cost of goods sold from revenue as a financial accounting measure, while contribution margin specifically separates variable from fixed costs for management decision purposes. Option C is incorrect because operating income is calculated after subtracting both variable costs and fixed costs from revenue, which would include the $8,000 rent, and produce a different figure. Option D is incorrect because net income is the bottom line profit after all expenses including interest and taxes, not the amount remaining after subtracting only variable costs from the per unit selling price. A bakery sells cakes for $30 each. Variable costs per cake are $18. That leaves $12. What do you call that $12? Contribution margin per unit. Contribution margin is what remains after you subtract variable costs from the selling price. That $12 contributes toward covering the bakery's fixed costs, the $8,000 in monthly rent, utilities, insurance. Once fixed costs are fully covered, every additional $12 goes straight to profit. Gross profit is a financial accounting concept that subtracts cost of goods sold from revenue. Similar sounding, but different, because it doesn't split costs into fixed and variable categories the same way. Operating income subtracts both variable and fixed costs, so it would factor in that $8,000. Net income goes even further by subtracting interest and taxes. Neither of those equals the $12 described here. Here's a WGU C213 OA exam tip for you. Selling price minus variable cost per unit always equals contribution margin per unit. If the question stops at subtracting variable costs and doesn't touch fixed costs, it's contribution margin. Quick recall. Hook. Price minus variable equals sign contribution. What's left contributes to covering fixed costs. 42. A manager planning a new product launch needs to determine how many units must be sold before earning a profit. At break-even, total revenue exactly equals total costs and target income equals 0. Which formula correctly expresses the key variable relationship at break-even? A. Revenue minus fixed costs equals 0. B. Fixed costs minus variable costs equals 0. C. Revenue minus all costs equals 0. D. Variable costs minus revenue equals 0. What do you think is the answer? Correct answer, C. Revenue minus all costs equals 0. Explanation. Option C is correct because at break-even, target income equals 0, and sales revenue minus variable costs minus fixed costs, which are all costs, equals 0 at break-even. Option A is incorrect because this formula ignores variable costs entirely, which are a critical component of total costs that must be subtracted from revenue along with fixed costs to determine the actual break-even point. Option B is incorrect because subtracting variable costs from fixed costs does not produce a meaningful break-even calculation, since revenue must be included in the equation to determine when total sales cover costs. Option D is incorrect because starting with variable costs and subtracting revenue reverses the proper order of calculation, producing a formula that does not represent any valid break-even relationship. A manager needs to find the break-even point for a new product. At break-even, the company earns 0 profit. Revenue exactly covers all costs. The formula is straightforward. Sales revenue minus variable costs minus fixed costs equals 0. Or said another way, revenue minus all costs equals 0. That's the CVP break-even formula. One wrong answer subtracts only fixed costs from revenue and ignores variable costs. You can't find break-even if you leave out half the costs. Another subtracts variable costs from fixed costs, which produces a meaningless number because revenue isn't even in the equation. The fourth option reverses the formula. Variable costs minus revenue, which gives a negative number at any point above 0 sales and doesn't represent break-even. The real formula always starts with revenue on top and subtracts everything the company spends. Here's a WGU C213 OA exam tip for you. Break-even means revenue covers all costs, both variable and fixed. Any formula that leaves out one type of cost or omits revenue entirely is wrong. Quick recall hook. Break-even equals sign. Revenue minus all costs equals 0. Both variable and fixed must be in there. 43. In cost-volume profit analysis, total profit depends on 3 key factors. Sales revenue depends on units sold, selling price, and the mix of items sold. Fixed costs depend on management choices about spending levels. Which statement correctly describes what determines total variable costs in this framework? A. Management choice of investment level. B. The company's total asset base. C. The industry's average cost structure. D. Units sold and variable cost per unit. Can you guess the answer? Correct answer, D. Units sold and variable cost per unit. Explanation. Option D is correct because variable cost depends on the number of units sold and the variable cost per unit, making volume and per unit cost the primary determinants. Option A is incorrect because management choice of investment level relates to strategic decisions about long-term assets and capital structure, not to how variable costs are calculated based on production volume. Option B is incorrect because a company's total asset base reflects its accumulated investments in resources, which is a balance sheet concept unrelated to how variable costs behave relative to units sold and produced. Option C is incorrect because while industry benchmarks provide context, a specific company's variable costs are determined by its own unit volume and per unit costs, not by what competitors spend on average. CVP analysis breaks profit into 3 pieces: sales revenue, variable costs, and fixed costs. The question tells you what drives revenue and what drives fixed costs. Now it asks what drives variable costs. The answer: units sold and variable cost per unit. Total variable cost equals the number of units sold multiplied by the variable cost per unit. Sell more units, variable costs go up. Each unit carries a set amount of variable cost that doesn't change per unit. The sales mix also plays a role if you sell multiple products with different variable costs. Management's investment decisions affect the balance sheet and fixed cost levels, not variable costs. The total asset base is a financial position measure. Industry averages give you context, but don't determine your specific variable costs. Your variable costs come from your volume and your per unit rates. Here's a WGU C213 OA exam tip for you. Variable costs in CVP depend on units sold, cost per unit, and mix. Fixed costs depend on management choices. Revenue depends on units, price, and mix. Know what drives each piece. Quick recall hook. Variable costs equal sign VAR. Volume times per unit rate. That's the whole formula. 44. A company sells two products, one with a high contribution margin ratio and another with a low ratio. If the sales mix shifts so that more total revenue comes from the low margin product, what is the most likely effect on total profits, assuming total revenue stays exactly the same? A. Profits will increase proportionally. B. Profits will decrease. C. Profits will remain unchanged. D. Profits will double from the shift. Do you know the answer? Correct answer, B. Profits will decrease. Explanation. Option B is correct because not all products have the same contribution margin ratios, so shifting the mix toward lower margin products will significantly reduce total profits even when overall revenue stays constant. Option A is incorrect because shifting sales toward a lower margin product reduces the average contribution margin across the company, which decreases total profits when overall revenue stays at the same level. Option C is incorrect because profits depend on the contribution margin mix of products sold, not just total revenue, so a shift toward low margin products reduces profitability even when sales dollars are unchanged. Option D is incorrect because shifting sales toward a lower margin product could never double profits. This shift reduces the weighted average contribution margin and therefore reduces rather than increases total earnings. Same total revenue, but the sales mix shifts toward the low margin product. What happens to profits? They drop. Sales mix is the proportion of revenue each product represents. Different products have different contribution margin ratios. When you sell more of the low margin product and less of the high margin one, the weighted average contribution margin falls. Revenue is the same, but there's less contribution margin per dollar to cover fixed costs. Imagine a restaurant that sells both lobster with a 50% margin and water bottles with a 5% margin. If people start ordering mostly water bottles, total revenue could stay flat while profits collapse. The takeaway for managers: maximize contribution margin on all products, then push the ones with the fattest margins hardest. Here's a WGU C213 OA exam tip for you. If a question describes a sales mix shift toward lower margin products with the same total revenue, profits always decrease. Revenue alone doesn't determine profit, the margin mix does. Quick recall hook: same revenue plus worse mix equals lower profit. Mix matters. 45. When constructing a cost-volume-profit graph, the total cost line and the total revenue line intersect at one specific point. Below this point, the company operates at a loss, and above it, the company earns a profit. What is this intersection point on the CVP graph commonly called? A. The break-even point. B. The contribution margin line. C. The fixed cost threshold. D. The profit maximization point. Can you guess the answer? Correct answer, A. The break-even point. Explanation. Option A is correct because the break-even point is the specific point on the CVP graph where total revenue and total cost lines intersect, meaning revenue exactly equals total costs and profit equals 0. Option B is incorrect because contribution margin is the amount remaining after variable costs are subtracted from revenue, not a name for the intersection point where the total revenue line meets the total cost line. Option C is incorrect because fixed cost threshold is not a standard term in CVP analysis, and the fixed cost line on the graph is drawn separately from the intersection of revenue and total costs. Option D is incorrect because the intersection of total revenue and total cost lines represents zero profit rather than maximum profit, and maximization occurs at higher sales volumes well beyond the break-even intersection. You're building a CVP graph. You draw the total cost line and the total revenue line. They cross at one point. Below that point, the company loses money. Above it, the company makes money. That crossing point is the break-even point. Constructing the graph, start with dollars on the vertical axis and units on the horizontal. Draw the fixed cost line, a flat horizontal line. Then draw the total cost line, starting at the fixed cost level and sloping upward at the variable cost per unit. Then draw the revenue line starting at 0 and sloping up at the selling price per unit. Where revenue and total cost cross, break even. The contribution margin line isn't a standard CVP graph term for this intersection. The fixed cost threshold isn't a recognized CVP concept at all. The profit maximization point would be way above break even. The intersection represents zero profit, not maximum profit. Here's a WGU C213 OA exam tip for you. On a CVP graph, the intersection of total revenue and total cost is always the break-even point. Below it means losses, above it means profit. Quick recall hook. Revenue line crosses cost line equals sign break-even. Zero profit, the starting line. 46. A factory pays $20,000 per month in building rent, regardless of whether it produces 100 units or 10,000 units. As production rises, the rent per individual unit produced decreases. Which cost behavior pattern is demonstrated by this monthly building rent? A. Variable cost pattern. B. Stepped cost pattern. C. Fixed cost pattern. D. Mixed cost pattern. What do you think is the answer? Correct answer, C. Fixed cost pattern. Explanation. Option C is correct because a fixed cost remains the same in total, regardless of production volume. But cost per unit decreases as more units are produced, which matches this rent behavior. Option A is incorrect because a variable cost changes in total directly with production levels while remaining constant per unit, which is the exact opposite of the behavior described for this monthly building rent. Option B is incorrect because a stepped cost increases with activity in discrete steps rather than remaining constant at all volumes, while the rent stays at 20,000 regardless of how many units are produced. Option D is incorrect because a mixed cost contains both a fixed and variable component, while the rent described is purely fixed at 20,000 per month with no variable element tied to production. $20,000 a month in rent. Doesn't matter if the factory makes 100 units or 10,000. The total stays at 20,000. But the rent per unit, that changes. At 100 units, it's $200 per unit. At 10,000 units, it's $2 per unit. That's a fixed cost. Fixed in total, variable per unit. A lot of students trip on this. They see per unit cost decreases and think variable. But variable costs work the other way. The total changes with volume while the per unit amount stays flat. Stepped costs jump at certain thresholds, like hiring an extra supervisor when you pass 500 units. The rent doesn't jump, it's flat at 20,000. Mixed costs have both a fixed floor and a variable component. This rent has no variable piece at all. Here's a WGU C213 OA exam tip for you. Fixed cost is fixed in total, variable per unit. Variable cost is variable in total, fixed per unit. These two patterns are mirror opposites. The total behavior determines the classification, not the per unit behavior. Quick recall hook. Fixed equal sign flat total. Variable equal sign volume driven total. Look at the total first. 47. Two competing companies have the same total costs and break-even point. Company A has high fixed costs and low variable costs per unit, while Company B has low fixed costs and high variable costs. If both experience a sudden sales increase above break-even, which company benefits more? A. Company B with low fixed costs. B. Both see equal profit increases. C. Neither company will benefit. D. Company A with high fixed costs. Can you guess the answer? Correct answer. D. Company A with high fixed costs. Explanation. Option D is correct because high fixed costs with low variable costs indicate high operating leverage, meaning each additional sale above break-even contributes more to profit since variable cost per unit is smaller. Option A is incorrect because Company B has low operating leverage due to low fixed costs and high variable costs, so each unit sold above break-even contributes less profit than it would for Company A. Option B is incorrect because the two companies have different cost structures, creating different levels of operating leverage, so the same sales increase produces different profit impacts for each competing company. Option C is incorrect because both companies benefit from increased sales above break-even, but the question asks which benefits more, and operating leverage determines the magnitude of profit change from volume shifts. Two companies, same break-even point, same total costs, but different cost structures. Company A has high fixed costs and low variable costs. Company B has low fixed costs and high variable costs. Sales surge above break-even. Who wins bigger? Company A. This is operating leverage in action. Company A's variable cost per unit is small, so each additional sale above break-even contributes a large chunk towards profit. Company B's variable cost per unit is high, eating into each sale and leaving less for profit. Think of it like a seesaw. High fixed costs amplify the swing. Bigger losses below break-even, bigger gains above it. Low fixed costs dampen the swing. Smaller losses below, but smaller gains above. The trade-off is real. Company A carries more risk if sales drop, but reaps more reward when sales climb. Here's a WGU C213 OA exam tip for you. High fixed costs plus low variable costs equals high operating leverage. Above break-even, high leverage means bigger profits. Below break-even, bigger losses. It cuts both ways. Quick recall hook. High fixed equals sign. High leverage equals sign big swings. Amplified gains and amplified losses. 48. A company's utility bill contains a base monthly charge of $500 plus an additional charge that increases with machine hours used. Before this cost can be used in cost volume profit analysis, the accountant must separate it into two components. Which type of cost has both elements? A purely variable cost. B, a mixed cost. C, a purely fixed cost. D, a stepped cost. What do you think is the answer? Correct answer, B, a mixed cost. Explanation. Option B is correct because mixed costs have both a fixed component, which is the base charge of $500, and a variable component, which increases with the number of machine hours used. Option A is incorrect because a purely variable cost has no fixed component and changes entirely based on activity level, while the utility bill described here includes a constant base charge regardless of machine usage. Option C is incorrect because a purely fixed cost remains entirely constant regardless of activity level with no variable component, while the utility bill here increases with the number of machine hours actually used. Option D is incorrect because a stepped cost increases in discrete jumps at certain activity thresholds, while the utility bill described has a smooth, variable component that rises continuously with each additional machine hour. The utility bill has a $500 base charge every month no matter what. Then there's an extra charge that climbs with machine hours. That's two pieces, a fixed piece and a variable piece. Combined, they make a mixed cost. Before you can plug this into CVP analysis, you need to break it apart. The fixed piece goes with fixed costs. The variable piece goes with variable costs. A purely variable cost has no fixed floor. It would be zero if the machines didn't run at all. This bill still costs $500 even at 0 hours. A purely fixed cost has no variable component. It stays flat regardless of activity. This bill goes up with usage. A stepped cost jumps at thresholds. 1,000 at 100 hours, 2,000 at 200 hours. This bill increases smoothly and continuously with each hour, not in discrete jumps. Here's a WGU C213 OA exam tip for you. A cost with a base charge plus an amount that varies with activity is always a mixed cost. The key phrase is base charge plus additional variable. Before CVP analysis, mixed costs must be separated. Quick recall hook. Fixed floor plus variable. Climb equal sign mixed cost. Must split before using in CVP. 49. An accountant needs to separate a mixed cost into its fixed and variable components for decision making. The accountant has historical data showing total costs at various activity levels. Which analytical method uses only the highest and lowest activity levels and their associated costs to calculate the variable rate? A. High-low method. B. Scattergraph method. C. Regression analysis method. D. Average cost method. Do you know the answer? Correct answer, A. High-low method. Explanation: option A is correct, because the high-low method uses the highest and lowest levels of activity and their associated costs to calculate the variable cost rate and then determine the total fixed cost component. Option B is incorrect because the scattergraph method involves visually plotting a straight line through all available data points on a graph, rather than using only the two extreme points at highest and lowest activity. Option C is incorrect because regression analysis is a statistical method that uses all available data points to compute the best fitting line, not a method limited to using only the highest and lowest activity observations. Option D is incorrect because the average cost method divides total costs by total units to find an average, without separating the cost into fixed and variable components as the accountant needs for cost, volume, profit decisions. You've got a mixed cost and you need to separate it. You have historical data at various activity levels. The high-low method uses just two data points, the highest activity level and the lowest activity level, along with their costs. You subtract the low cost from the high cost, divide by the difference in activity levels, and that gives you the variable cost per unit of activity. Then you plug that back in to find the fixed portion. It's quick and dirty. The scattergraph method plots all available data points on a graph and draws a best fit line visually. That uses every data point, not just the extremes. Regression analysis is statistical. It calculates the mathematically best line through all the data. The average cost method just divides total costs by total units and gives you one blended number without separating anything. Here's a WGU C213 OA exam tip for you. Highest and lowest activity levels only is the dead giveaway for the high-low method. If the question says all data points or visual line, think scattergraph. If it says statistical, think regression. Quick recall hook. High-low equal sign two extremes only. Scatter equal sign plot them all. Regression equal sign math them all. 50. A company with high operating leverage has invested heavily in automated equipment, resulting in very high fixed costs, but very low variable costs per unit. If sales suddenly drop below break-even, what financial consequence is most likely compared to a competitor with low operating leverage? A. It will lose less money overall. B. Its losses will be unaffected by leverage. C. It will lose more money than competitors. D. Its fixed costs will automatically decrease. Do you know the answer? Correct answer, C. It will lose more money than competitors. Explanation: Option C is correct because the higher the operating leverage, the more money a company loses if sales fall below break-even, since high fixed costs continue regardless of how far sales volume declines. Option A is incorrect because high operating leverage means greater sensitivity to sales changes in both directions, so the company will actually lose more money than a low-leverage competitor when sales drop significantly. Option B is incorrect because operating leverage directly affects how much profit or loss a company experiences when sales fluctuate, meaning leverage has a very significant impact on results when sales decline below break-even. Option D is incorrect because fixed costs do not automatically decrease when sales drop, which is precisely the problem with high operating leverage, since those costs continue at the same level regardless of volume. Company with high operating leverage, lots of automated equipment, sky-high fixed costs, tiny variable costs per unit, sales drop below break-even. What happens? The company hemorrhages money faster than a low-leverage competitor would. This is the dark side of operating leverage. When sales fall, fixed costs don't budge. 20,000 in rent is still 20,000, whether you sell 10 units or 10,000. A low-leverage company has lower fixed costs, so the bleeding is slower when volume drops. The high-leverage company won't lose less. It loses more. Leverage absolutely affects the magnitude of losses. And fixed costs don't automatically shrink just because sales decline. That's the entire problem. The same amplification that produces outsized profits above break-even produces outsized losses below it. Here's a WGU C213 OA exam tip for you. Operating leverage amplifies everything. Above break-even, high leverage means high profits. Below break-even, high leverage means high losses. Same concept, both directions. If the question asks about sales dropping below break-even with high leverage, the answer is always bigger losses. Quick recall hook. High leverage below break-even equals maximum pain. Fixed costs don't care about your sales volume.
You have reached the end of our first question set. For the free complete exam preparation, visit our website, link in the description, where you find thousands more practice questions and comprehensive study guides. Thanks for studying with us today. See you in the next video.